So I want to get more on Greece now with my guest. He helps oversee over $160 million in assets. Yannick Naud is portfolio manager at Glendevan Asset Management. It's great to have you with us. And so we have no definitive agreement on Greece. We're told this is because of the need for more technical work on the deal. Do you buy that?
Well, it's technical, but it's all about money. The base case scenario of the Troika is that by 2020, the debt to GDP will be at 144. The IMF wants 120. You have to find 24%. So there's a lot of small things that you can do to reduce it. I mean, if, for example, the ECB forego the capital gain on Greek paper, it's 4.6%. It's equivalent to 4.6% of
But Yannick, we knew all of these things before they went into the meeting.
Yes.
We knew the options that were on the table, lowering the interest rates on Greek loans, the public sector taking a haircut on existing loans, and then what to do with the ECB profits on those loans. Why are you disappointed that they haven't come to an agreement?
Well, the IMF came with the right solution. Lagarde came with the right solution. The best solution and the quickest solution and the easier solution financially would be for a government, even the ECB, to take a haircut.
She's been saying that for the last few months.
And she's right. Nonetheless, she's the minority partner in the Troika, so she can't decide exactly. Do
you think she'll be forced to give in?
I think she will. The IMF, by status, have to make sure that the debt is sustainable. So it's not giving in, not giving in. They will have to make sure that Greece will be able to get back to 120% of GDP, wherever in 2020 or 2022.
Which is impossible without the public sector taking part in restructuring, without taking a hit on the face value of these loans.
Yes, you can achieve more or less the same effect by reducing the rate from 1.5% to 0.25%. I think it's equivalent to 5% of GDP, 5.1% of GDP, or to have much longer maturity. In fact, it's a kind of restructuring. When a corporate issuer say to bondholder that they will pay back in 20 years instead of 5 years with almost 0% interest rate, it's amount to a creative anyway.
Extending the repayment deadlines, it's still a form of restructuring. So what sort of language do you expect here at the beginning of next week?
Next week, they will probably talk about reducing interest rate, longer maturity, 10 billion buyback in the market, I would assume, and the ECB to be able to forego the capital gain. Will it be enough for Greece to achieve the magic 120% of GDP by 2020? I doubt it, but it will make it a bit more likely. You have to keep in mind that now we are around 170% of GDP. It's bound to get worse before it gets better. In 2014, it's probably going to be 190% of GDP.
I think it's going to be 189 next year, debt to GDP. So what needs to happen to get to 120 debt to GDP by 2020? What else needs to happen apart from the measures that they'll discuss next week?
If you can't grow the country, and the country has not been able to grow for the last 17 quarters in a row, you need to make sure that the debt is lower. Or at least it's longer, and therefore the net present value of the debt is much lower. That's the only way around. Otherwise, you will not be able to. It will not be sustainable for the country to repay the debt.
What is the best way to play all of these developments? You see the German yield. I mean, right now, we have a German bond auction today. But I mean, does it make sense to invest for 10 years in German debt? Just looking at where we are at the moment, little change this morning. Yeah, at 1.4%. Well,
it doesn't make sense to invest for 10 years at 1.4%. I mean, there's inflation, and you have to keep in mind that the asset itself is quite volatile. You have more than 5% volatility, implied volatility or historical volatility. So it's just a short-term way to park your asset in order to have a bit less exposure to either peripheral Europe or credit risk. But in the long term, it's not. If you invest at 1.4%, you will not be able to pay for the inflation.
But you do prefer Finland. You would go long on Finland because you get the safety that you have from having being a core country, no exposure to the periphery, but a little bit more yield than Germany.
Finland asked for collateral when it was lending to Greece. You get paid slightly better than Germany because you get something like 23 basis points wider, and you have the probability. I mean, it's a small probability that if Finland choose to exit the Eurozone, you might be able to be repaid in a domestic currency that could be stronger. That's a very it's not going to happen tomorrow. It could be a very long process, but that's a possibility.
Yeah. Currency risk still at the forefront of many people's minds right now. Thank you so much, Yannick Naud, portfolio manager at Glendevan. Thank you again.